Hi, today we are going through Rich Dad Poor Dad by Robert Kiyosaki. And look, I know you've probably heard about this book a million times because, well, it's sold over 40 million copies, right? Everyone and their cousin, their sister has an opinion on it. But here's what they missed out. Whether you love Kiyosaki or think he's full of it, the core ideas in this book genuinely changed how millions of people think about money. And some of these concepts, especially if you've never had them before, can be pretty mind-blowing. So the basic setup is this. Kiyosaki had two father figures growing up, while his real dad, the poor dad, was highly educated, had a good government job, followed all the rules. He went to school, got good grades, climbed the career ladder, but he struggled with money his entire life. Then there's his best friend's dad, the rich dad, who barely finished high school but became one of the wealthiest men in Hawaii. And the book is basically Kiyosaki comparing the mindset and advice from these two men. What poor dad said about money versus what rich dad said. And spoiler alert, they said very different things. Now, before we go further, just a quick disclaimer. Some of Kiyosaki's later stuff has been criticized. Some of his investment advice is controversial. Some people think he oversimplifies things, and that's all fair. But the fundamental principles in this book about how to think about money, those are solid. And that's what we're focusing on today. Over the next few minutes or so, we are going to go through my 6 main lessons from this book. And honestly, if you just get these 6 things right, even if you don't agree with everything else Kiyosaki says, you'll think about money differently. So let's get into it. Lesson 1. The rich don't work for money. So this is the first and probably most important lesson. The rich don't work for money. Now I know that sounds weird, right? Because everyone works for money. But here's what Kiyosaki actually meant. Most people are trapped in what he calls the rat race. You wake up, you go to work, you earn a paycheck, pay your bills, and then you do it all over again next week. And I know you're thinking about yourself right now because it's probably true. And even when you get a raise, what happens? Your lifestyle inflates. You get a big apartment, nicer car, more expensive restaurant, so you need to even work harder to afford this new lifestyle. And at the end of the day, you are still stuck in the same cycle. Rich Dad's philosophy was a little bit different. He said, don't work for money, make money work for you. And the way you do it, that is by acquiring assets that generate income while you sleep. And that's the game. Now, young Robert didn't get this at first in the book, so he and his friend Mike started working for Rich Dad for 10 cents an hour, which is a terrible pay, I know, right? And after a few weeks, Robert got fed up and wanted to quit. That's when Rich Dad taught him the first lesson. In the book, he said, most people let fear and greed control their financial lives. Fear of not having money makes you go to work every day. Then greed makes you want more, so you work harder or look for a better job. But you're still working for money. You're still letting emotions drive your decisions. Rich Dad told Robert, if you want to be wealthy, you need to learn to make money work for you instead. And that means learning to think differently about what work actually is. Here's a key quote from the book. The poor and middle class work for money. The rich have money work for them. So what does this look like practically in our case? Well, instead of just working your job and spending everything you earn, you start thinking about how to acquire things that generate income. Rental properties that bring in rent every month, stocks that pay dividends, businesses that run without you being there. And that's the shift. Your time and effort go into building assets, not just trading hours for dollars. And Kiyosaki emphasizes that this mindset shift usually has to happen early. The longer you stay in employee mindset, the harder it is to break out. You get comfortable with the paycheck. You get used to the security, even that security is kind of an illusion. Does this mean you should quit your job tomorrow and try to become an entrepreneur? Not necessarily. What it means is you need to start thinking beyond your paycheck. Your job can fund your asset purchases. Your salary can be the tool you use to buy your freedom, but the job itself isn't the end game. The real wealth, according to Rich Dad, comes from owning things that produce income whether you show up or not. And that's the fundamental difference in thinking between rich and poor. And once you understand that, everything else in the book builds on it, as we will see later. Lesson 2. Why teach financial literacy? Lesson 2. Why teach financial literacy? And Kiyosaki's answer is simple. Because it's not taught anywhere else, and without it, you can't build wealth. Now think about it with me for a second. You probably spent years in school learning algebra, history, biology. But did anyone ever teach you how to read a financial statement? Did anyone ever explain what an asset actually is versus a liability? Did anyone teach you how taxes work or how corporations are structured? Probably not. And that's the problem. Without financial literacy, you can't tell the difference between something that makes you money and something that costs you money. You make bad decisions without even knowing that they're bad. So Kiyosaki breaks this down with something super simple but incredibly important: the difference between assets and liabilities. An asset, according to Rich Dad's definition, is something that puts money in your pocket. A liability is something that takes money out of your pocket. And that's it. Forget the accounting textbook definitions. Just think about cash flow. Does this thing bring money in or does it take money out? And here's where it gets interesting. Most people think their house is an asset. It's probably the biggest purchase they'll ever make, right? They are building equity. It's an investment, right? Kiyosaki says no. For most people, your house is a liability. Why? Because it takes money out of your pocket every month. Mortgage payment, property taxes, insurance, maintenance, utilities, money flowing out. Now, if you rent that house and it generates more income than it costs to run, then yes, it becomes an asset. But your primary residence, that's a liability in his view. This was actually one of the most controversial things in the book when it came out. People got really upset about the house thing, and I see why. But Kiyosaki's point isn't that you shouldn't own a home. His point is that you need to understand what it actually is financially. It's a place to live. It might appreciate in value, but it's not putting money in your pocket every month. It's taking it out. So financial literacy means being able to look at your balance sheet and understand. So financial literacy means being able to look at your balance sheet and understand what's actually making you wealthy versus what's just making you look wealthy. Here's another example he uses. You buy a new car. Is that an asset or liability? Most people would say asset because it's worth something. But the moment you drive it off the lot, it loses value. And every month you're paying for gas, insurance, maintenance, you name it. Money still flowing out. That's a liability. Now compare that to buying a rental property. Maybe it costs you money up front, but every month tenants pay you rent that covers the mortgage and expenses, and hopefully leave some profit. Money flowing in, so that's an asset. Kiyosaki says wealthy people focus on building a column of assets, things that generate income, while poor and middle class people focus on building a column of liabilities, often while thinking they are assets. Big house, fancy cars, expensive clothes, all taking money out. And the reason financial literacy matters so much is because without it, you can't even see the difference. You think you're doing well because you have nice stuff, but if you actually looked at your cash flow statement, you'd see money hemorrhaging out every month. So the lesson here is a little bit straightforward. Learn to read financial statements, understand assets versus liabilities, know where your money is actually going, and this is the foundation. Without this knowledge, you're just simply guessing, and guessing with money, well, we all know rarely works out well. Lesson 3, mind your business. Lesson 3 is something Kiyosaki calls mind your own business. And this is where it really gets into the difference between your profession and your business. So according to the book, this is what he actually meant. You might be a teacher, an engineer, a nurse, or whatever, you name it. That's your profession. That's how you earn income. But that's not your business. Your business is your asset column. Your business is what you're building that will eventually produce more income without your labor. Most people spend their entire lives building someone else's business. You go to work, you make your boss money, you make the shareholders money, and you get a paycheck. Nothing wrong with that one. But if that's all you're doing, you're not building wealth for yourself. Rich Dad told Robert, mind your own business. Keep your day job for sure, but start building your asset column. Start acquiring things that generate income, because that asset column is your actual business. That's what's going to make you wealthy. And Kiyosaki is really specific about what counts as good assets to focus on. He lists several, and here are some of them. First, businesses that don't require your presence. You own them, but they run without you being there. And that's the dream for most of us. Second is the stocks. Not trading, not trying to time the market, but investing in solid companies that pay dividends. The third is bonds, which are literally corporate or government bonds that pay interest. Fourth, and his favorite I think, real estate that generates rental income. And the fifth is notes, like if you loan someone money and they pay you back with interest. Sixth business is royalties from intellectual property. Think of music, books, patents, anything that pays you every time it's used. And seventh and lastly is anything else that produces income and appreciates in value. Notice what's not on that list. Your car, your boat, your expensive watch collection. Those aren't assets in Kiyosaki's framework. They don't produce income. They cost money to maintain. They depreciate. Now, he's not saying never buy nice things. He's saying buy them with the passive income from your assets, not with your paycheck. First build the asset column, then let the assets buy your luxuries. Here's a powerful mindset shift from this lesson. When you get money, whether it's your paycheck or a bonus or a tax refund, your first thought should be, what asset can I buy this? What asset can I buy with this? Not what can I spend this on? Most people get extra money and immediately think about upgrading their lifestyle. New TV, nicer vacation, better phone, and look, that feels good in the moment, but it doesn't build wealth. Wealthy people get extra money and think, how can I turn this into an asset that generates more money? Maybe they buy stocks. Maybe they put it toward a down payment on a rental property. Maybe they invest in starting a small business. The money goes into something that will produce returns. Kiyosaki shares a story about how he loves Porsches. He really wanted one, but instead of buying it with his job income, he bought a small storage facility. The cash flow from that storage facility eventually paid for the Porsche. The asset bought the luxury, and he still owned the asset at the end of the day. That's minding your own business. Your day job funds your life and funds your asset purchases. Your assets fund your luxuries and eventually fund your life when you don't want to work anymore. The trap most people fall into is they make good money, but they spend all of it. Their profession pays well, but their business, the asset column doesn't exist. So they are always dependent on the paycheck. They can't retire, they can't take time off, they are stuck. Mind your own business means building that independence, building the thing that works for you while you're doing everything else. And that's the game right there. Lesson 4: the history of taxes and the power of corporations. Alright, lesson 4 gets into taxes and corporations. And I'll be honest, this is where some people start tuning out because taxes sound boring. But stick with me for a moment because this is actually where a lot of wealth is built or lost. Kiyosaki's main point here is that the tax code is written to benefit business owners and investors, not employees. If you're an employee, you get taxed first, then you get to spend what's left. If you own a business, you earn, you spend, then you get taxed on what's left. And that difference right there is pretty massive. So let's break that down, do some math a little bit. Say you're an employee making 100k a year. The government takes taxes off the top, maybe 25% or 30% depending on where you live and your deductions. So you're left with 70k or 75k to actually spend. Now let's say you own a business that generates the same amount, that is $100,000. You get to pay for business expenses first. Office space, equipment, maybe a business vehicle, meals, travel, all of that stuff. All of that is pre-tax. Then you pay taxes on what's left. You're playing with a different set of rules. Now, Kiyosaki is clear that he's not advocating tax evasion or anything legal. You'll probably end up in jail. He's saying, learn the rules. The tax code is complicated for a reason. And within that complexity are legal ways to minimize what you pay. And most wealthy people know this. They use accountants and tax strategies to take advantage of every legal deduction and credit. The rich dad philosophy is, don't work hard and make more money just so you can pay more taxes. Work smarter to structure your income in ways that are tax efficient. He also talks about the power of corporations. When you set up a corporation, even a small one, you gain certain advantages. Limited liability, meaning your personal assets are protected if the business has problems. And well, of course, tax benefits because corporations can deduct expenses that individuals can't. This is why wealthy people don't just earn income and pay personal income tax on everything. They set up entities, they structure things, they use the tools available in the tax code. Now here's where I'll add some context. Kiyosaki doesn't emphasize enough in the book. All of this stuff requires help. You need a good accountant. You need to understand what you're doing. You can't just randomly set up a corporation and start deducting your groceries. That's fraud, but the principle is sound. If you're serious about building wealth, you need to understand how taxes work and how to legally minimize them. Because every dollar you save in taxes is a dollar you can invest in assets. Kiyosaki tells the story of Rich Dad teaching him and Mike about corporations when they were still teenagers. He wanted them to understand early that the game has different rules for different players. And if you want to win, you need to know which rules apply to you. Employees play by one set of rules. Business owners play by another. And investors play by yet another. The tax code rewards certain behaviors like investing in real estate, starting businesses, creating jobs, while it penalizes others like just earning a salary and spending it. The lesson isn't that you need to quit your job and incorporate immediately. The lesson is, as you start building your asset column, as you mind your own business, understand how to do it tax efficiently, because that efficiency compounds over decades into enormous differences in wealth. Lesson 5: the rich invent money. Lesson 5 is about financial intelligence and creativity. Kiyosaki calls it the rich invent money. And what he means is that opportunities are everywhere, but you need financial education to see them. He tells a story about being in his 40s when the real estate market in Phoenix crashed. Prices plummeted, most people saw disaster, they saw risk, they stayed away from real estate. But Kiyosaki saw opportunity. He understood that the market was down, which meant assets wouldn't sell. He knew how to analyze deals, he knew how to structure financing. So while everyone else was scared, he was buying properties at huge discounts. And when the market recovered, he made significant returns. That's what he means by inventing money. It's not about literal counterfeiting or anything like that. It's about using your financial intelligence to see opportunities that others miss. He contrasts two types of investors. The first type, which is most people, just hands their money to someone else. They put it in a 401k or a mutual fund and hope someone else manages it well. They are passive, and for that, they are hoping. The second type actively looks for opportunities. They educate themselves, they understand markets, cash flow, risk and return. When they see a good deal, they know it's a good deal because they can analyze it and they have the confidence and knowledge to act. Kiyosaki emphasizes that financial intelligence is about having options. The more you know about money, taxes, markets and investing, the more opportunities you see. And the more opportunities you see, the more chances you have to grow wealth. He also talks about the importance of taking risks. Not reckless ones, of course, but calculated ones. Most people are so scared of losing money that they never take any risk at all. They keep everything in a savings account and earning almost nothing. They avoid the stock market because it might go down, but here's the reality. Inflation is a risk. Keeping all your money in cash means it loses value every year. Not investing is a risk. Playing it safe has a cost. Rich Dad taught Robert that the biggest risk is not learning. If you don't educate yourself about money, you can't see good opportunities. You can't tell the difference between a smart investment and a scam. You're actually in more danger because you're making decisions from ignorance. So, inventing money is really about developing the skills to identify opportunities and the courage to act on them when they appear. Another key point to note here is that wealth isn't just about money, it's about knowledge, relationships, and skills. Kiyosaki talks about how Rich Dad always encouraged him to learn things, new things of course. Take classes, read books, talk to people who know more than you, because all of that education compounds into the ability to create wealth. He also says that mistakes are part of the process. You're going to make bad investments. You're going to lose money sometimes. That's tuition in the school of real world finance. But if you learn from it and keep going, those lessons become incredibly valuable. The lesson here is clear, and it's this: don't just work for money and hope it grows. Develop your financial intelligence. Learn how money works. Study investing. Understand markets. Because that knowledge is what allows you to create wealth even when opportunities aren't obvious to, well, everyone else. Lesson 6. Work to learn. Don't work for money. The final lesson is about career choices and what you should be optimizing for, especially early in your working life. Kiyosaki says most people choose jobs based on salary and security. They ask, how much does it pay? Is it stable? And that makes sense if you're thinking like Poor Dad. But if you're thinking like Rich Dad, you ask different questions. What will I learn? What skills will I develop? He tells his own story. After college, instead of taking a high-paying job, he joined the Marines to learn leadership. Then he worked for Xerox to learn sales. He didn't need the money desperately, but he needed those skills. And those skills ended up being worth far more than any salary he gave up. The idea is that when you're young or when you're starting to build wealth, skills are more valuable than salary. Learn sales, learn marketing, learn to communicate, learn to lead, learn accounting. These skills compound throughout your life. Kiyosaki is especially critical of specialists. He says the world is full of talented people who are broke, amazing engineers who can't sell, brilliant writers who don't understand business, incredible artists who can't manage money. His advice is to become a generalist in business skills while you're building wealth. You don't need to be the best at any one thing, but if you can sell a little, manage people a little, understand financial statements a little, run marketing campaigns a little, then you are incredibly valuable. And more importantly, you can run your own business. He tells people to look at their resume as a list of skills, not a list of jobs. What can you do? What do you know? And if there are gaps, go learn those things, and even if it means taking a lower paying job or position temporarily. The other thing he emphasizes is learning by doing. Reading books is great, taking courses is helpful, but nothing replaces actual experience. Start a small business, even if it fails. Buy an investment property, even if it's small. Make real deals with real money. That's where the learning actually happens. So the final lesson ties everything together. You're not just working to earn money to pay bills. You are working to learn skills that let you build assets. You are developing financial intelligence. You are minding your own business on the side. And eventually, all of that comes together into financial independence. Alright, let's wrap this up. Rich Dad, Poor Dad in a nutshell. The rich don't work for money, they make money work for them through assets. Financial literacy is essential because without it, you can't tell assets from liabilities. Mind your own business by building an asset column, not just working your job. Understand taxes and corporate structures to keep more of what you earn. Develop financial intelligence to see and create opportunities, and work to learn skills that let you build wealth, not just to earn a paycheck. Now look, you might not agree with everything Kiyosaki says. Some of his advice is controversial. Some of his examples are specific to real estate in ways that might not apply to you. But the mindset shift, the fundamental ideas about assets versus liabilities, about financial education, about thinking life like an owner instead of an employee, those are incredibly valuable. If you take nothing else from this, just take this. Start thinking about what assets you are building, not what stuff you are buying, but what's actually putting money in your pocket, because that's the path to financial freedom. If you want to go deeper, definitely read the full book and check out the resources in the description for more frameworks on building wealth. And just as a free gift to you, there is a summary with actionable points on this exact book, and it's in the description, so go check it out if you're serious about this. Subscribe if you want more book summaries like this one. Thanks for listening. Now go build those assets.